Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this video, we will talk about practical ways to protect your money from fintech risks, including diversification, checking licenses, and watching for regulatory news. Let's continue learning how to keep your finances safe. Firms relying on unsustainable high interest rates. Many newer fintech companies use a strategy called customer acquisition at any cost. They offer massive interest rates to pull users away from established banks. While this sounds great for your wallet, it's often a sign of a dying business model. These firms are basically paying you to use their service with venture capital money. Once that funding dries up, they have no way to keep the lights on or pay out those high rates. This creates a rob Peter to pay Paul scenario that looks a lot like a Ponzi scheme. They need a constant flow of new deposits to pay back the old ones because their actual lending business isn't profitable. When the economy slows down and new users stop joining, the whole tower collapses. You don't want to be the last one holding the bag when the music stops. If the rate is significantly higher than the federal funds rate, it is a major warning sign. Specific red flags in financial technology lending. Lending is where shadow banking gets even more complicated and dangerous. Many fintechs don't actually have the right to lend money directly, so they use rent-a-charter schemes. This is when a tech company partners with a small, obscure bank in a state with loose usury laws. The small bank signs the papers, but the fintech does all the work and takes the profit. This practice often leads to legal nightmares for everyone involved. Regulators are constantly cracking down on these partnerships, which can lead to frozen funds and sudden company closures. Feature healthy fintech risky shadow bank. Banking status licensed or FDIC insured partner, no clear insurance or offshore base. Lending style asset-backed or high credit scores, unsecured or subprime focus. Fee structure clear and upfront, hidden in the fine print. Revenue source transaction fees and stable loans, investor cash and risky bets. The table above shows that a healthy company focuses on stability while a risky one focuses on growth at any cost. You should prioritize the safety of your principal investment over the hope of an extra return. Heavy reliance on unsecured personal loans. You should be very wary of fintechs that lend money to people with low credit scores without any collateral. These are often called unsecured personal loans or buy now, pay later services. In a good economy, these companies look like geniuses because everyone is paying their bills. However, these borrowers are usually the first to stop paying when a recession hits. Because there is no house or car for the company to take back, the money just disappears. If a fintech has a portfolio full of these risky loans, its value can drop to zero in a matter of weeks. You are basically betting on the financial health of the most vulnerable consumers. That is not a recipe for long-term investment success. Instead, look for companies that back their loans with real assets. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.